Good afternoon, everyone. Um, I just want to make sure that everybody can hear me. I was having a lot of trouble with getting my mic working. I don't know why, but if you can hear me, if you could put a yes in the chat box, I'd really appreciate it. Okay, great. Okay, thank you. All right, well, we're going to begin. I really thought I was going to have a technical problem, but all of a sudden my mic flashed on and I wasn't any of the connections. So it's a brand new mic. It's only a month old. So that aside, this is Mark from Right Line Trading, and what I'm going to be going over with you today is called our code breaker credit spread option service. You're going to see that it's very, very unique. We're winning about 85% of our trades. Now, I just want to tell you right up front that I take every single trade in my real money portfolio that I send out to you. We executed a trade today on this big pullback. We got a huge net credit for it. And we have really been rocking on the service. It's a great trade methodology to utilize in this market. And in fact, in my opinion, as you're going to see, there are only a couple of option strategies you really need to master to become a successful options trader. We are with this service, and I am in general. I've been doing exceedingly well in the market. I've hit my portfolio equity high, all-time high trading. And today, believe it or not, in this blood red market, I only had a really minor setback in my portfolio. The drawdown was very, very minimal because it's diversified and we're really well positioned in our trades. Now, the credit spread strategy really provides us with a lot of with a lot of power. Now, just as a quick disclaimer that all signals and trading opportunities that I provide are for educational demonstration purposes only. I'm not a licensed money manager, and everyone understands that trading involves substantial risk and that you can lose a substantial amount of money. So always carefully consider your financial position. And what I tell all my traders, and I just sent out a very, very expensive trade, and I told them not to take the trade unless they can afford potentially to lose 100% of what they risk. The likelihood of that is close to zero, but you have to take that under consideration. Now, just a little bit about my background. I graduated from an Ivy League university. I went to the University of Pennsylvania for 8 years, and I majored in applied mathematics. And within that field, I focused on mathematical modeling. I did a lot of work in that area. I did my honors thesis in that area. I graduated in the top 2% of my class. For that, I was inducted into the Phi Beta Kappa Honor Society. I graduated summa cum laude with honors. And it was always my goal, my career goal, to go into teaching and research. So I applied to a number of universities for a full-time professorship position, and I ultimately took a position at Jefferson University. I wanted to stay in Philadelphia. I had a lot of friends there, a lot of established business connections as well. And while at Jefferson, I published 15 peer-reviewed articles in top-tier journals. I was a full-time professor. I taught an enormous number of undergraduate and graduate students. I did a significant amount of research in the area. I've always had the mindset of that of a scientist, a teacher. I'm sorry. I'm being told I'm showing my son here on the screen. Hopefully I'm fixing that now. Is that fixed, Rory? Okay, great, thank you. Well, you got a good look at my son. That's an older picture, but that's him. Thanks. So I've always had the mindset really of a scientist, a teacher, and an academician. I'm not a salesman, and I don't sell you software. What I'm doing is I'm really selling you a service that I hope is really going to teach you how to become an exceedingly successful trader. I've been an invited speaker internationally in many countries. I've been an invited speaker locally in many cities, and it's always been my goal. And sorry, here I'm getting a little distracted because let me turn my phone off here. And I believe that I've mentored close to 30,000 traders over the course of, and that's now 11 years. Many of them in groups, some of them one-to-one. Now, obviously, what you're looking for is an option strategy that's going to provide you with consistent income in any market. And I'm telling you, using credit spreads, although they're not going to be powerful in every market condition, is a tool that you must have in your kit if you want to trade options successfully. Now, you hear options gurus all the time telling you, you never buy options, you always sell them, and that's the magic. But that is not the case. But there are some very specific instances. I'm going to show you what they are because I'm going to show you my entire formula. You're going to learn how I do it in this webinar. I mean, this is really not all fluff where I'm going to sit here and yada yada at you for the entire hour, 45 minutes. I'm going to show you how I trade. But this is a critical strategy that you need to utilize if you want to trade successfully. If you don't have it, you're going to be really at a major disadvantage. And right now is a great time to sell options. And I'm going to show you why. Now, the other thing that I wanted to mention is jumping between strategies. Now, I watch a lot of other webinars, and I see that, you know, a lot of them really boil down to providing you with 9, 10, or 11 different strategies. It's really just an options trading for dummies book on a video series. But you don't want to focus on 10, 7, even 6 different option strategies. I think that you really can get by with focusing on 3. It's like 3 legs of a stool. This is one of those legs. If you don't have it, the stool is going to fall over. And in the most opportune times, when you can make an exceedingly large amount of money with substantially little risk by selling options, you're not going to have that leg on that stool. Now, the reason I'm going to show this to you, and I want to teach you how to do it, is I want you to understand the fundamentals of the strategy and exactly how it works. So I don't want to give you a black box system and just talk, interview some other guy who's walked into my life and provided, and is just trading really incredibly well, but give you no information about how it's done. Now, you may have heard that you don't have to win many options trades to be a successful trader. You can win 30% and make a ton of money. You can win 25% or make a ton of money. Well, let me tell you, nothing can be further from the truth. Now, I'm going to talk a little bit about risk to reward as we proceed, but you're going to have to win at least 50% of your trades and probably more than that to be a successful options trader, and I'm going to show you why. And then I'm going to show you what we need to do to place the rules in discipline, to trade with the discipline we need, and insert the rules that we follow to prevent any individual trade from blowing up. We want to make sure that we follow through with the most important thing possible, and that is to preserve our capital. If I was to ask you what is the most important thing or the most important mandate we have when we trade, well, it's not making money, believe it or not. It's preserving the money we have in our account. That's number one, is not to lose any money. And then a close second is that we successfully are able to multiply our profit and grow it over time. So capital preservation is really of paramount. I want to give the market any money. See, can you still hear me? Is everything okay with my mic? Can you give me a yes on the mic? Can you still hear me okay? Okay, great. So you're going to gain confidence as the fundamental understanding of the strategy works. You're going to gain consistency. Now, this is a very simple strategy, and it's extremely forgiving. In other words, if you buy a call, that trade's got to move in your direction. And same thing if you buy a put. You buy a bull call spread, you buy a bear call spread, it's got to move in your direction. In many ways, these are non-directional trades. Now, we have to pick a direction because we have to have a directional bias, but the trade can move against us for a fairly significant amount, and we can still walk away with the winning trade. So it's a very forgiving strategy with a higher probability of success than just buying a put, buying a call, or buying a bullish spread or buying a bearish spread. On every spread, you have limited risk and you have limited reward. The only kind of trade that you have unlimited risk and unlimited or limited risk and unlimited reward is when we just buy a call or buy a put. And we're never going to sell a naked position because in that particular case, our downside is unlimited. So why learn to trade credit spreads? Well, you can make money if the stock price increases, decreases, or doesn't move at all. In fact, if a stock moves flat, it's terrific for us. We really only need the stock to stick right where it is for us to make 100% of our credit. And we have an extremely limited loss potential. So again, we never have to worry about trades blowing up when the market makes a huge move like it did today. I didn't look exactly at the close because I was working to log on, but in a really down market like today, the loss we're going to take on any given trade is going to be very minimal. And again, it's a very simple strategy that I'm going to show you. It's very cookbook. And what we want to trade is something that's very formulaic. It's not 25 pages in your cookbook. It's half a page. It's so simple to learn. You just have to know what to look for in the underlying stock and in certain options metrics, and you can hone right in on these trades. Now, you may have the understanding that a stock has three directions, but a stock actually has two directions, up or down. But a stock really has 5 directions. Now, it can move sideways in very tight consolidation. And over the course of the period of time that you're holding the option, the price may not appreciate or depreciate to any given degree. It's just going to move in a tight consolidation pattern. Then you have to make an anticipation of whether the trade is going to have a mildly bullish or mildly bearish move into the future, or it's going to make a bold move to the upside or really collapse to the downside. Now, we can be wrong about whether it makes a weak move up or a strong move up. We can be wrong about whether it makes a weak move down or a strong move down, as long as our bias is appropriate. But it's really important to try to differentiate between a modest move up and down versus a strong move up and down, because we're going to trade those differently. If it's going to make a strong move up, we want to buy a call. If it's going to make a strong move down, we want to buy a put. But if we believe that that stock is going to just take a mildly bullish move or a mildly bearish move, or potentially just trade sideways in consolidation, we want to sell a credit spread. Let's sell an option, either bullish for long or bearish for short. So on these kinds of trades, if we're bearish on the position, it really only has to move 1 cent down from where we place the trade for us to make 100% of the credit we receive when we sell the options. Now, when do you want to be an options seller, and when do you want to be an options buyer? Now, there are going to be times when it is extremely advantageous to buy, and there's going to be times when it's extremely advantageous to sell. It is not one thing all the time. So credit spreads are positions you sell, and when you sell them, the trader who you sell them to pays you for them and gives you a credit. Now, if the trade moves in the anticipated direction, you get to keep 100% of the credit you receive. Now, when do you want to sell your positions to somebody else? Well, you want to be a buyer of options when the cost of the option is cheap. And you want to be a seller when the cost of the option is high. Now, how do you determine whether the option is cheap or the option is expensive? I mean, I put in a trade today for a $1,000 stock, and the cost of the position was $3,000. It was one of the most expensive positions I've ever recommended in a different options portfolio. It doesn't matter though. Are those options cheap or are they expensive? And all we have to do, well, I'm going to talk to you in a minute about that. So do you want to be a buyer? And remember that the market is an auction-based system. So do you want to be in the audience bidding on the option? You're sitting in there, there's a man standing up in front with a gavel, he's auctioning off the option. You want to be in the audience and pay a fee for the item, which is the option? Or do you want to be the seller? Do you want to be the man with the gavel, banging it and yelling out a price and letting the people in the audience bid on it? And you collect the fee for dumping the option onto somebody else. And really, it really all comes down to implied volatility. Implied volatility, when it's exceedingly low, will create a low cost option. And when implied volatility is high, the cost of the option is going to be exceedingly high as well. And we call that IV rank. Now, IV rank should be in any options platform that you trade. On Thinkorswim, it's the third metric I look at after open interest and my delta. I mean, the bid ask is something I can look at easily, but I want to know the implied volatility or the intrinsic volatility of the option I'm trading. If it's high, 100%, 133%, 200%, 300%, you want to dump it on someone else. And I promise you, if the option has nice liquidity, somebody will be more than happy to take it off your hands and pay you a huge amount of money for taking that option from you. But when implied volatility is very low and very cheap, you want to be in the audience, you want to be bidding on it, you want to purchase it. So IV rank is really the key to determining whether we're going to sell an option or whether we're going to buy it. And to use this strategy, and I send out trades every week, I look for terrific stocks that have very high IV rank. I'm looking for 50 to 100% IV rank. That's going to provide us with a really nice credit when we sell our option spread. Now, what pumps up the value of the option is that implied volatility, and that inflates its price. Now, usually an option has high implied volatility when something is coming up. There may be some event, maybe it's earnings. It could be a number of different things. I mean, it could be one of the tech stocks right now in the AI space, like NVIDIA. They're going to have very high IV ranks because the market anticipates that they're going to make huge moves in price. But what we are going to make is this assumption that there's going to be an arrow heading into that bubble. And when it hits, the value of the option is simply going to collapse. Now, when it happens, someone else is holding it, and you have the ability to buy it back from them at your discretion. So let's say you sold it to them for $300 and you got $300 in your account per spread. All of a sudden, volatility completely implodes, and the value of the spread is now $25. You get to buy it back for $25 and keep $275 per spread. The other thing is that time decay is on your side because you want the options to expire worthless. If they expire worthless, the other guy now has a worthless position, and you get to keep 100% of your credit because you don't have to buy it back at all. So it's really, really favorable to have time on your side. And this is the only time you make money over the weekend. If you go to your platform and you say it says 42 days to expiration, they're including Saturday and Sunday in those days. So if you you close your portfolio on Friday and open it on Monday, and the closing price of the stock, underlying stock, is say 65, opening price is 65, you're going to find that you have gained money on your position simply because of time decay that occurs over the weekend. So that's how advantageous the position is. And having time on your side is really, really a tremendously positive factor. Now, I'm just going to give you some examples. Now, this example is not a trade I would take. It's really just for educational purposes. I created it quite some time ago. It's really not important. But this is on Abbott Labs. And this is on another platform that I have. It's on it's from a broker called First Trade. Don't use them. I mean, they're really lousy. In fact, I would caution you against using them because I'm not sure they're really on the up and up. They've been around for a long time, but it's not a good platform. So you're going to sell. You're going to take right here a bearish position. And when you're bearish, and we're going to go over this, so don't worry about. I just want to acquaint you with it. When you're bearish, you're going to sell 2 calls. You're going to sell 1 call and buy a call. When you're bullish, you're going to sell a put and you're going to buy a put. So if you sell the stock is right at 98. So we're going to sell the $98 call and get $2.84 of credit. Then we're going to buy the 103 call and get 77 cents of credit. So what do we collect per spread? We collect $207. Now this is a lousy spread and I would never take it, but I just want to show you how mechanically we execute the trade, because it's on a $5 width. 93 from 108, 98 from 103 is $5. Now we want a lot more money on this trade than $2.07. I don't like this spread, but I just want to show you how it's generated. So we can collect 207, but if you look right here, we're at risk for $293. So it's not an optimal option to sell, but I just want to show you how we do it. And the reason we do is I use the 30 EMA. Every time the stock pulls back to the 30 EMA, we sell a spread. Pulls back, we sell a bearish spread. Pulled back, we sell a bearish spread. Pulls back, we sell a bearish spread. Pulls back, we sell a bearish spread. Now, these are not great metrics. I'm going to show you some really good metrics in a second, but I just want to give you a little bit of an idea. Now, why we sell the 98 and buy the 103, I'm going to show you also. But I want to show you how forgiving this strategy is. Now, we make $207 and the stock is trading at 98 and we're bearish on the trade. Now, if the stock closes at $97.99, 1 cent below, or even right at 98, we make 100% of our credit. If it moves down at all, we make 100% of our credit. Now we received $207 on a trade that I would configure. I would make much, much more than that. I would want to make $240. I would want to make much more than 207. I would want to try to get a risk to reward that's close to 1-to-1. But given the metrics we have, if it moves down at all 10 cents as we approach options expiration, we're going to make 100%. Now, let's say that we're wrong. Now, we have a $207 profit sitting in our account. So we have a $2.07 cushion. So between 98 and $100.07, we're still going to make some profit. This is what makes it such a forgiving strategy. We want the trade to go down, but if it moves up $2.07 in price, we're going to collect some percentage of the credit we received on the trade when we took it. So at the end of the day, we're going to bank money on the trade. And it's even more forgiving than that. Because let's say it trades between 107 and 103. Now, that was our the amount of money we had at risk, but we're not going to lose 100% of that until it's greater than $2.39. So if it trades between 107 and 103, we're only going to take a partial loss. We had $293 at risk, and I screwed these numbers up. I just want to give you conceptually how the trade works. I'm going to show you other trades, but it can move against us a considerable degree, and we're only going to take a partial loss. Now, hopefully, we're only going to take a very minimal loss, if anything. Now, I'm not going to talk about trade repair and how we manage it, but with repair of trades, and repairing a trade is never cheap. It's expensive. But if I think we only have about 5 or 6 losers in the portfolio in its history. Every one of those would have been profitable if you would have repaired the trade per my instructions, if you were willing to take the risk on the repair. But if you don't, this is just a partial loser. And the only time you're going to trade in the red is if a $98 stock moves above 103. Now, that's a big move up. You have to be really wrong if that happens. And we're going to close the trade long before it gets to 103. We're going to bail on this trade. We're not going to allow it to take a 100% loser. But you can see how forgiving it is. If it moves against us, $2.07, we're going to make some of our profit. If it moves against us more than $2.07, all the way to 103, we're going to only take a partial loss. If it moves so much against us above 103, that's when we're going to take a full loss, but we're not going to allow that to happen. So an optimal credit spread is based on how much you get based on the vertical width of the trade. Now, I'm going to be reviewing this with you over and over in our live sessions. You don't have to internalize it or feel like you have it 100% under your belt with this webinar, but we're going to be reviewing this over and over again. And when you see the trades, I'm going to give you all the metrics. Now, let's say we take a trade on a $5 wide vertical, and we only get 33% of our potential net credit on a $5 wide. So we have 67%. So we're going to make $166, put $334 at risk. Terrible risk to reward. Now, it requires 67% winners to break even. You win 2, you lose 1. Win 2, lose 1, win 2, lose 1. Trade at 67%, you're going to wind up only losing commissions. And this is taking a full loss on every single trade. But we are not trading with a vertical width of 33%. We're going to look for a vertical width between 40, 45, or higher on the trade. Now, if we change that to a vertical width of 41%, now we only have to make 60% of our trades profitable in order to break even. Now you lose 2, you win 1, you win 2, a buck each, you lose 1, you lose $1.50. Make 2, lose $1.50, make 2, lose $1.50. Now, every 3 trades, you're going to wind up Can you hear me now? Okay. My audio good? Okay. I don't know what's going on with my mic. I'm gonna have to have it checked. But on McEwen Mining, I took a $1 wide spread. It was a $6, $7. And I'm going to show you exactly why I sold the 7 and bought the 6. I got a net credit of 45 cents. So my vertical width, I had $45 I could make, and I only lost $55. Could lose $55. Now, I sold the $7 put. So we want the trade, we want McEwen Mining, the underlying stock, to trade anywhere above $7 at options expiration. Now, between $7, because we got $45 of cushion, that's our net credit, it could trade all the way down to $6.55, and we're going to still make some money. That's to trade below 655 in order for us to lose anything. Now, we're not going to, as I said, allow those trades to head down that low. But if we get a 45% premium on every trade we take, we only need to win 55% of our trades. And like I said, we're winning upwards of 85%. Now, McEwen Mining was a big winner. We made 100%. It didn't close above 7. It closed above 850. Now, I didn't believe it was going to make that much of a bullish move, or I would have bought a call. But you see, it had very high implied volatility. The options pricing were very expensive. For us to get a 45% premium on an option spread, we sold, and we sold the $7 and bought the $6 puts for a bullish spread. This was a very, very advantageous trade. These are the kind of trades we're looking for on every trade we take. These kind of metrics. So we only have to win about 55% of our trades. And if we do, given that we take full losers on every loss, we're going to be profitable if we can win 55%. Now, I wanted to show you how you can look at this on a long-term basis. And this is the communications services sector. Now, every now and then I'm going to take a trade on iShares or the Spider. Now, they usually don't have very high implied volatility. So trading sectors is usually not particularly lucrative when you sell. Those are the kind of trades you want to buy. But on communications, if we look at the 30 EMA, every pullback to that 30, buy a bullish spread, pullback, buy a bullish spread, pullback, buy, pull it, pullback, pullback, pullback. Now you've got 1, 2, 3, 4, 5 winners in a row, and then finally communications turns on us. So we've got 5 winners, and then we're going to take a partial loser. And then what do? We switch direction. The 30 EMA starts sloping down, and every move back up, we sell, winner, sell, winner, sell, winner, sell, winner. So we can trade one stock as it moves up, retraces, moves up, retraces, moves up, retraces, back to the 30, doesn't breach it, confirms that it's going to move, maybe hits it again, retests, moves up. We're going to be back in on a bull spread as long as it gives us that vertical width of 42, 43, 44, 45%. Now, what is the formula for doing this? It's really easy. We're going to sell the at-the-money call or put, and we're going to buy the out-of-the-money 25 delta call or put. Now, I'm sure you're acquainted with people that buy deeply out of the money spreads, and they're going to tell you that they're going to win 90% of their trades, and they're going to be potentially correct. If you buy a spread with a delta of 10, you're going to probably win 90% of your trades. That's what the market is pricing in. But what you're going to do, and I just saw this last week, somebody was talking about how they make steady income selling options. And what they were doing is just using the spider. And to make $50, they were risking $1,000. And I kid you not, that was only mentioned once in the entire hour. The only thing that was continually mentioned was the win, the win, the win, the win. Well, it's all well and good until you get 2 losers in a row, and it's going to happen. And when it happens, you're going to be down $2,000. Now, to make that back in $50 increments, that's 40 winners in order to make back 2 losers in a row. That's going to take you a year of trading. So trading deeply out of the monies, which I see very commonly, is a losing strategy. This is an optimized strategy that I have found works over and over. And I've been doing this for years. We're going to sell the at the money, the 50 delta, and buy the out of the money, the 25 delta. If we're bullish, we use puts. If we're bearish, we use calls. It's such an easy trade to configure. The sort of the hard part is finding the underlying stock that we believe has a distinct trajectory and has really nice implied volatility. Now I'm going to skip this slide and skip this one too. Now here's just XLV, and that was a great short trade for a long time here. This is going 4 months. And XLV was really bearish for a long time. Obviously, that's changed now, and I like XLV as a sector. But every time we got to move back to the 30 EMA, we sold, move back, sold, move back, sold, move back, sold, move back, and sold. So we need something that has nice implied volatility and a distinct direction. And we have to make a decision whether we believe it's going to be mildly bullish or strongly bullish, mildly bearish or strongly bearish. And bottom line is, it's got to have a high implied volatility. If it doesn't offer us a huge amount of premium on the risk, on the options we sell, we're not taking that trade. We're going to move on to another stock, and we're going to keep searching. Now, all the metrics on a credit spread, I'm going to give you on every trade. So obviously, you're going to know the direction, because if I sell puts, we're bullish. If I sell calls, we're bearish. So let's just take an example of a bullish trade. I'm going to sell the 50 delta put, and I'm going to buy the 25 delta put. There's no discretion. And that's the kind of formula you want, where you are fixed by a recipe that is not mutable. Because when you have the ability to start tweaking with it and tinkering with it and tampering with it, all you're going to do is wind up walking yourself into a loser. You have the 50 and the 25. Now, occasionally you're going to get a really great trade where you don't have a 50 delta. It'll be a 52 delta, a 53 delta, a 54 delta, or a 27 delta, a 23 delta. That's okay. You know, you're not breaking the rules. But that 50-25 is the target we want on each of the paired calls or puts we trade. So the 2 arms of the trade, we sell 1 put and we buy 1 put on a bullish. We sell 1 call and buy 1 call on a bearish. The premium is important. Premium width is critical. and I'm going to give you the premium with percentage, which is the key on every trade. And what determines the premium percentage is the IV rank. You know, if that premium percentage is really juicy, up around 45%, you know the IV rank has got to be very high. So just to go over it again, we're going to sell the 50 delta, buy the 25 delta. Bullish puts, bearish calls. Now I put 33% distance, but we want 45% optimally. I'll take a 43% if I feel really confident in the direction that the trade is going to take. I'm good with it. Now I'm going to give you some trades that are currently sitting in our portfolio. Now one is Toll Brothers. Now Toll, I don't know what happened to it today. It's closer to 120. I probably pulled back a little bit today. I can open my trader and I can take a look at it and see where I am, where Toll closed today. But yesterday, I put in a order to buy it back for a nickel. Now we received $1.85 in credit, and it hit that nickel and just sat at the nickel for like, I don't know, 25 minutes, because I was watching it on Thinkorswim, and I saw the price of the spread was 5 cents. It would not fill me. So since I take every trade live on my own account, I did not book it as a winner. It may have filled other people, but I'm not going to take the trade as a winner unless I get it out. Now today, Toll took $3.80, 83% loss. I mean, that's a significant loss, but we still have $5 of upside, and the trade is turning the corner into April. And right now, I can tell you the value of the spread just by looking at my Thinkorswim portfolio. The value of the spread is 13 cents. Now, I could close it at 13 cents and still make really nice money, but I'm going to wait and hold it for that 5 cents of buy it back for 5 cents and make the $1.80. Here's another trade I took on Huntington Ingalls. Now, this is trading, I can tell you, we got $7.50 of credit on the trade. Now, this is a $20 spread. I don't like taking them, but I did it because I really like HII. And I think it's going to make a nice move. Now, HII, like most tech, and HII is more mixed. Let me see where it is here in my portfolio. It's pretty wary. We lost 1.42% today. And the value of the spread is really down there. I can't tell you exactly what it is because I don't have a sell order in yet on it, but we are rocking with Huntington Ingalls. Now here's Pinterest. We have the 32.38. We made $2.45 of credit on the trade. We have a huge downside cushion, and Pinterest only lost $40 today on the spread. So it's trading exceedingly well. Now, how do I find the stocks? What I do is I look at the best performing sector. Now, right now, I really like healthcare. I do like the financials. I'm a little concerned about the financials because our economy is still running hot, and the Fed may not drop interest rates. And interest rates are what are really propping up financials right now. So I was looking at the financials for our new trade, and what I wound up taking was a trade in the energy area, because I think what's going on in the Middle East is just going to push up energy. Now, when I wrote this slide, which was about 3 months ago, the best performing sector was energy. The best performing subsector within energy was oil services and drillers. And I look at the best stocks within these subsectors for our trades. And it tends to be when a stock is on the move, it tends to gain volatility. And those are the kind of stocks that are going to give us a great net credit on the trade. Now, I have to look tonight. I'm going to look at Schlumberger. I'm going to look at a number of stocks in the oil services subsector. Except I did execute a trade today. And we got an enormous net credit on it. I'll tell you what it is. Hang on. It really pulled back a little bit too much for me. Installed building products. Now, what the reason I like installed building products is because home sales overall are sort of perfunctory. They're not really moving really heavy duty. People who own homes are tending not to refinance, and they're tending to hold on to them. But new home sales, despite the high interest rates, are skyrocketing. And this is a company that makes a lot of building materials and things that go into new homes. And I can tell you one of the reasons why that's why I bought Toll Brothers, and why Toll Brothers has just rocketed out of the gate. It's because the people who are buying the homes are the Chinese. And it's something that I just know for a fact, just by doing a lot of reading. They're buying huge, 5, 10 acre plots and putting up massive amounts of housing and selling them at an enormous profit. So that's really what's driving new home sales. And the money behind it is really coming from China. And new home sales is really moving at a record high. So that's why I like that company. Now, this is a credit spread tracker. Now, it comes in First Trade, but it's really pretty awful. And I almost never use it. I could send you a snapshot of it every week, but I'm telling you, it won't help you trade. It just looks at implied volatility, and it ranks the stocks by IV rank. It does take into account their direction, but I'll tell you, I almost never take a trade off this scanner. It does look at liquidity. It looks for a minimum of a 33% vertical width, which we're not going for. It looks for trades that have a directional edge, but we are much better pickers. And I want you to know that any scanner is just based off of a fixed code. And when they get really, really sophisticated AI, that'll be a little bit different. But any fixed code algorithmic system is never going to be as good yet as we are. And I just read a long treatise last night about the metaverse and the omniverse. And one of the predictions by one of the probably the brightest guys, based on his track record, he states that by 2035, AI will be smarter than we are. And it will learn faster and have a higher IQ than we do. Now, when that comes in 2035, these kinds of platforms will be immensely powerful. Right now, they're not. So I'm going to show you some trades that we closed in the past. Vertev, I sold the 42.50. I bought the 37.50. I got $2. That was a 40% vertical width. I bought it back at 30 cents, and I made 85% on the trade. Now, there's a reason why I don't hold some of these to options expiration. It's called gamma whip. I don't want to go. Okay, that should bring me back. I'm sorry about this. I will get this fixed. Okay, we made a buck 70, 85% of our potential net credit, which is why I could really close toll now. But we got time on our side so heavily, and I'm still so bullish on the trade on TOL. Not going to panic on this one-day pullback. Okta, oh my God. We bought the 82.50. We sold the 82.50, bought the 77.50, $5 width. This was a 42 or 43% vertical width. 250 would have been 50%. So we were right around 45% on the vertical width of this trade. Okta is now trading at 105. I never anticipated it would make a move like that. Well, we got 100% of our net credit. This one I risked going into expiration, and we cashed out with all of our credit. Now I'm going to just stop for 1 second and tell you how you're going to trade profitably. There's one more part of the formula, and that is you're going to risk the same amount on every trade. It doesn't matter how much you risk, whether you want to risk 300, 500, 1,000, 4,000, that's irrelevant. But if you don't risk an equal amount on every trade, you're putting yourself behind the 8 ball. On MUX, you're only risking $55 per spread. So let's just round it to 50. So if you traded, say, 500, you were willing to risk $500, you could take 10 spreads. Now on this trade, you're risking $275. So you're only going to trade 2 spreads because that's right around the $500 level. You decide what your risk tolerance. I'm going to try to keep the vertical width small as I can. I don't want to trade a 20 wide. You have to bend my arm to trade a 10 wide. I really like the 5 wides, the 2 wides, and the $1 wides. So we've booked 37 trades. We have 32 winners, 5 losers. That's an 87% win rate. Now, if you took the credit repair strategy that I will teach you in the upcoming live sessions, now it's going to require some money because anytime you try to put a Band-Aid and turn a loser into a winner, you're going to need a little bit of loot. But if you got it and you would have taken it like I did, I turned every loser into a winner. I have 100% winners, and I don't spread BS. And I can't go into how you Band-Aid these trades, but it's a very, very easy way to do it. And I'm going to show you how to do it. But like I said, it needs more capital. But you'll also notice I didn't factor that into our win-loss rate because I'm going to make the assumption that a lot of traders don't have the capital that it takes to Band-Aid the trade. So if we lose on the trade, I'm going to book it as a loser. I'm going to show you how to Band-Aid the trade. I'm going to do it. And if we make money, I'm still going to give you advice on our evolving trade, looking to recover our money and then make money on that trade, but it's still going to be booked as a loser. And I just threw this in here because somebody just sent this to me. This came 3/19/2024. FYI, one of your stock picks, Fusion, was bought out today by AstraZeneca. The price of the stock doubled. This one, I sold my calls. He made 300%. Now, that's kind of hard to believe, but if something simply skyrockets like that, you can make a lot of money. If people are still in the trade, you may want to let them know if they've not already discovered this. But we had Fusion on a spread. Now, what happens is there's an explosion of implied volatility that creates an options imbalance. And you can actually get out for more money than is theoretically possible. So it's my old adage, those that can do and those that can't do teach. There's a million people out there who are going to offer you trades, but I'm telling you, none of them are going to tell you they take them. I take every trade I send out, because if they're good enough for you to take, why aren't they good enough for me to take? Because it's a nice source of income for me when I make money on the trades I send out. In fact, that's my primary source of income. So if somebody doesn't take the trades on an alert service they send out to you, then they're not worth the paper they're printed on. Because why should you trade them and not them? So I would keep that in mind. Now, here's what you're going to get. I'm going to try to give you 2 trades every weekend. I can't guarantee that, though. You're going to get 1 for sure. I have to find 2. And if I can't find 2 great trades, I'm not going to give you anything suboptimal. So believe me, I think we have 6 or 7 working trades right now. That's more than anybody can handle. So you're going to have more than enough trades to manage at any given time. Since I'm in the trade with you, we're going to baby it along together. I'm going to give you the stops, the targets. I'm going to tell you how to manage it. I send out so many updated emails during the course of the week. I probably, between all the alert services I do, I probably send out 20 emails a week. Many for this service. And this is a linchpin service, because if you can't sell options profitably, I don't believe you can make money trading options overall, because you don't want to buy expensive options. And they're a great opportunity for you to sell them to someone else, take a big piece of money from them, and then sit, and all the trade stock has to do is make a general move in your direction. No big lurch, 5 cents in your direction, and you're in. I'm obviously in intra-week updates on any credit spread that's been a big change in price, and that's what that email was about. That was actually taken from an email, I believe. We had Fusion Pharmaceuticals. They were purchased by AstraZeneca. The underlying stock went up 100% overnight. When it opened, the value of the spread we sold basically went to zero, and so much implied volatility was injected into it, even with a zero. I mean, the options skyrocketed. We were able to get out with over 100%. You're going to get bi-monthly live training sessions. I'm going to bring you up to speed. I want to make you an option seller master. And so I really want you to earn as you learn. And I'm going to, each trade is not just going to come, sell this, buy this. Here's your credit limit. I'm going to give you all the rationale, my fundamental understanding of the trade, my technical understanding of the trade, so you can understand and begin to learn why I take a trade the way I do. Now, I wish I could tell you I was a magician and 100% of my trades work. They don't, but 85% of my trades do work. Now, the price is really cheap, and I just want to go right here and tell you it comes with a 100% money back guarantee. If you don't like it within the first 30 days, you just send an email to info@rightlinetrading.com. I didn't put our phone number on the slide, but it's on the website, rightlinetrading.com. It's 786-732-4656. Rory, maybe somebody else will pick up the phone. You just tell them that you want a refund. You don't have to give a reason. Maybe selling credits or maybe selling spreads is not your thing. It should be your thing if you want to trade options profitably, but maybe the service just doesn't suit you. No problem. We'll give you your money back. I only want people aboard who want to be aboard. That's it. Now, the special offer we're offering is it's $49 for the first month or $698 for the full year. Both of them come with that guarantee. 30 days, you don't like it, you can just opt out and we will refund 100% of your money and you don't have to give us any reason. Now, the coupon code for the monthly is save $70 and the coupon code for the yearly is save 50%. Now, I hope Rory puts the we'll put the link in the webinar if you'd like to come aboard. But you're coming aboard. I'm back. I'm sure I have to buy a new cable. It's the cable attachment. That's the problem here. And all I have to do is buy a new cable and I'll be fine because my leg just brushed it. So as I was saying, you're really coming aboard at absolutely no risk. So let me just answer any questions that there are. Okay. Marvin, we'll give that to you. Sorry, it's happening again. If I brush against the cable, it's turning off the mic, and I've got to fix that. Let me see anybody else. Okay, assignment risk is really, Kumar, is really zero, because let's say that we're in a position where we get. I wasn't going to go into assignment because a lot of traders don't really understand it. And I was going to do that in the first live session, but it's really simple. Let's say you get assigned the stock on a trade. Remember, you're getting assigned on the put or the call you sold, but you still have the put or the call you bought. So all you do is take assignment on the opposite end. And that if you're assigned a stock long, you're going to simply get assigned an equal amount of stock short, and you're going to close the trade. So getting assignment is really, really not a big deal. I mean, it's a 1, 2, 3 kind of thing. If it throws your account into margin, into a margin, you have 72 hours to cover it. And if you don't exactly know how to exercise, just call your broker and tell them you want to exercise on the call you own or the put you own. They'll exercise it for you and zero you out. So getting assignment is not an issue. Okay. And Mr. Marvin, Rory sees the webinar, and we will give that to you. And yes, I'm gonna do a lot of live teaching. And again, there's a couple of questions about the guarantee. It is a no questions asked money back guarantee. You don't like the service, you don't like the trades, you don't get winners. I'm on the line, and if what I don't tell you is in any way inaccurate, you're more than welcome to your money back. So listen, everyone, I really appreciate your coming aboard, giving me your time. And I thank you guys who have come aboard. I really appreciate it. We have 4 people who have come. And hopefully we'll get more, because I think you will do really, really well with this service. Have a great evening, everyone. I wish you all the best. How many contracts? Marvin, remember, the number of contracts you trade is going to be based on the number of the risk you take. Let's say on a $5 wide, you can make 225 to lose 275 for one spread. That's selling. Let's say on a bullish trade, you're going to sell a put and buy a put. 10 contracts is 10 spreads. Now, the amount of money you put at risk is going to be whether you can do it. I mean, if you can, I mean, on MUX, you should have easily been able to open up 10 spreads because you're only on 10, you only had $550 of risk. I traded well over 10 spreads on MUX. So it really comes down to how much money you are willing to risk. Because remember, they don't cost you anything. You get paid to take these trades. And the more trades you take, the more spreads you take, the more money that goes into your account. The key is how much of that you get to keep. We want to keep all of it, but we're risking money for the potential to keep it all. So the number of spreads you want to trade, I don't want to talk in terms of contracts because you have to talk in terms of spreads because we're not trading one contract. We have to buy a contract and sell a contract. So the number of spreads is all dependent on the amount of risk you want to take on any given trade. Okay? Sure, Marvin. Just type it out. I'll wait for you. Okay, I don't see anything. Okay, here we go. Okay, some require a 20 wide, and remember, we have to sell the 50 delta and we have to buy the 25 delta. Now, let's say we're trading a $400 stock. The difference between the 50 delta and the 25 delta may be $20. Now, I'm not going to do that because I don't want to create a $20 wide. It's too risky. Even if we get a tremendous net credit, we're still risking a lot of money on the trade. But the distance of the vertical width of the trade is where is the 50 delta and where is the 25 delta. And obviously they're going to get numerically wider and wider as the stock increases in price. I mean, if you look at SMCI, which is trading at about 1,000, I mean, look, just take a look yourself. I don't know off the top of my head. I don't know where the 50 delta is and the 25 delta, but boy, I'm telling you, you're probably going to have to trade a $50 vertical width. And we may wind up getting a $25 net credit or $24 net credit. That's a lot of money. It's almost 50% of the vertical width. But you're risking 2,500 about, or 2,600 to make about 2,400. And I simply don't want to put that much on one trade. I like to sort of spread the risk around, and there's always a way of finding a trade that's better configured. And I only take the $10 wides when I have to. I like the $1 wides, the $2 wides, and the $5 wides. I'm going to give you the rationale for every trade I take. So listen, everyone, again, have a wonderful evening. I wish you all the best. And I really do thank you all for your time. I know how busy your day is, and I know how much, I know how much probably all of you put into trading. And today was a little bit of a rugged day. So everyone, again, have a great evening. I hope to see you, and I hope to see you aboard the service. And like I said, it's no risk. Thank you. Appreciate it. Take care, everybody.